There is something insane going on. This is probably your last chance to buy a house because house prices are about to explode and nobody will be able to afford the house. The White House is trying to force the Federal Reserve to lower down interest rates so that you will be able to afford the house. But what if I told you that is only going to make the situation so bad that the vast majority of people won't be able to afford the house? You might think that it should be the other way around. But what if I told you that it's not the Fed that determines your mortgage rate? And even if the Fed lowers down the interest rates to 0%, that is not going to bring down the mortgage rates. If you think that I'm exaggerating and house prices are about to explode, then watch the video till the end because I will explain everything step by step. And by the end of the video, you will be amazed that house prices are about to explode. If you're ready, give this video a thumbs up and let's dive right into it. A lot of people imagine that if the Federal Reserve lowers down interest rates, then mortgage rates should go down as well. That's not just what an average person believes, that's what the President of the United States thinks.
Everything is good. The one thing we have to do is get housing prices down and the interest rates down so people can buy the house. Because they're all making money, but they can't get the interest rate down. We have to.
Even a lot of senators believe so.
Americans deserve to become first-time homebuyers. President Trump has created the best economy in the world. The one thing that would make it better is lower interest rates.
And that's why they're trying to push the Federal Reserve to lower down interest rates, because they want to serve the average American. They want to serve the average people who are working hard so that they will finally be able to afford a house. Unfortunately, that's not how it works. A lot of people imagine that we have a bank and the bank borrows money from the Federal Reserve and then loans that money to you in form of credit card debts and also a mortgage. So if the Federal Reserve will lower down interest rates to 1% in this case, then the bank will be able to loan that money at 2% interest rates, and that's how we bring down the mortgage rate. This sounds great. This is how it's supposed to be. But unfortunately, it doesn't work like that. Because if it works like this, then why don't you go and open a bank? Opening a bank would be the best business in the world because you can simply open a bank, borrow money from the Federal Reserve, and loan it to everybody else at a lower interest rate. If it's so easy and so simple, why don't you go and do it? I promise you that I will be your first client and I will go and borrow trillions of dollars out of your bank if you can provide that money at 2% interest rate. I promise I will be there. I will become a trillionaire, you will become a trillionaire, and we will together invite Elon Musk and tell him, listen, you had to build spaceships, you had to build Tesla cars, but we became trillionaires just by opening a bank. Who is the smart guy here? Unfortunately, it doesn't work like that, which is why this system is not going to work. This is how banks actually work. The banks are basically the middlemen, and they are in the business of borrowing money from people who have money and loaning that money to people who don't have money at a higher interest rate. On one side, you have investors. Now, these are the people with extra money. This is me, this is you, this is anybody who has money. It can be a big financial institution, or it can simply be an average person. Now, we cannot rip these people off. This could be you who saved $100,000 or barely $10,000. Would you be willing to give that money for free to anybody? Of course not. But you're more than willing to invest that money so that it works on behalf of you and makes you more money. On the other side, we have people who want to borrow money. So these are the people who don't have money, but they want to buy a house. So they would get a 30-year loan, which we call a mortgage, and buy that house. It also could be a person who wants to buy a car and then he doesn't have the money, so he wants to go and borrow an auto loan and buy that fancy BMW. So all the banks does is that it takes the money from the people who have money and gives the money to people who don't have the money, and then they will pocket the difference. Now, for this transaction to work, this deal must be profitable. So the bank would go to the investors and ask them, are you willing to loan your money? The investors will say, oh, what kind of a business is that? Well, so he will think about the risks and the return that the business will do. The first thing is, of course, the risk. If it's a business type of a business and the investors doesn't know if this business will be successful or not, he will ask a much higher interest rate. But if it's a debt, which means that the money will be returned bank guaranteed, then he will ask for a lower interest rate. The second thing he will ask is, of course, the rate of return that we just talked about. But the most important thing when it comes to debt that investors care about is inflation rate. Inflation is how much the value of the dollar devalues annually. So if the dollar devalues by 2% annually and I make 2% as an investor, then I made no money or whatsoever because I made 2% and I lost 2% because this money was devalued. So if I want to make a real return, my real returns are anything that I make above the rate of inflation. So it all goes back to the inflation. If inflation is 2%, then investors are willing to accept 3% or 4%. If inflation is 10%, then nobody will accept 2% because investors are losing money on that deal. But banks have to make a profit on the investments that they make. And banks do not have a lot of cash in their hands because this is a bank and the bank borrowed money from investors and quickly gave it away to people who want that money, which means that the bank doesn't have a lot of cash. That is why we created something called fractional reserve banking. It allows the bank to show that you have your money in the bank, and it also gave that money away to someone else in the form of a mortgage. There's a lot of conspiracies about fractional reserve banking and that it shouldn't exist in the first place. But what do you think the bank's supposed to do? The bank is in the business of borrowing the money and loaning that money to someone else. If the bank will simply take your money and keep it in the bank, then the real question is that why would the bank do that? Do you think people have nothing else to do, that they will simply build an entire building, build an entire financial system only to keep your money safe? I mean, if you want to do charity, if you want to do that kind of a business for free to everybody, go ahead and do that. But that's not the world we live in. We live in a free market, capitalistic society. So the bank is there to make money. So the bank will take the money and give it to other people, which means that the bank doesn't have a lot of cash. Well, you might say, well, the bank should keep some cash. Let's imagine that the bank will take that money and will keep that cash in the bank account. Your cash is in the bank. What will happen over time? There is something called inflation. So the value of the cash that the bank keeps becomes less and less valuable. So the bank is losing money by keeping that cash in the bank, which is why, for these two reasons, banks never keep money in their bank accounts. I mean, they keep a portion of the cash, of course, but most of the money is being loaned to people so that this money is working on behalf of investors and making the investors rich and the bank rich. But how do we solve this problem if suddenly some people will come to the bank and will ask for money back? So imagine we have like 100 investors and we have 100 people to whom we gave the money. Now tomorrow, 20 people will come to the doors of Bank of America and will say, we want our money back. The Bank of America will say, well, your money is not there in the bank, so the Bank of America will start calling the people to whom it lent the money. For example, you who took a mortgage, and will tell you, listen, Michael, we actually gave you a 30-year mortgage, but unfortunately this investor wants his money back. Can you please give us back the $500,000 we gave you? You will reply and say, listen, I don't have the $500,000, and we agreed that it's a 30-year mortgage. So please respect your terms of the agreement, and let's just do it the way it was agreed in the first place. But on the other side, this investor wants his money back. So how do we solve this complicated situation, right? The banks, in order to function, they have to have a lot of treasury bills. These are super safe assets. These are the assets, this is the debt that the government of the United States has created. And these treasury bills pay interest. So on one side, we keep these treasury bills and we're not losing money to inflation because we are getting interest on these treasury bills. If inflation is 2%, the treasury bills provide us with 3 to 4% interest rate, which means that, yes, we're keeping these treasury bills and we're making money on these treasury bills. So even though that inflation is eating away money, we are making more than inflation on these treasury bills. So we're not losing money to inflation. On the other side, because we have these treasury bills, we have the Fed as well. Now, the job of the Fed here is that if we have such a situation where a lot of people get into the bank to ask for their money back, the bank can use the treasury bills as a collateral to borrow money from the Federal Reserve in the short run and give it to the investors. The bank will call the Fed and will say, listen, Fed, I have these 20 investors who want their money back and I don't have cash, but I have these treasury bills, which are super safe investments. Can I borrow money from you, the Fed, and I will give you this treasury bills as a collateral. So if I won't give you back the money, you can literally sell this treasury bills in the open market, and that's it. So you are safe. The Fed will say, all right, no problem, give me your treasury bills and take this $1 billion, return it back to the investors. Investors happy, the bank did not go bankrupt, and the next day, when the people who took the money from the bank, they return their money, for example, they're paying their mortgages, they're paying their credit cards, they're paying their auto loans, now the bank has the cash. The bank will take the cash, will go to the Fed, give back the loan that it took from the Fed, and get back its treasury bills. And that's why we have the Federal Reserve. It's not there to create money out of thin air, although that there is circumstances that it could possibly do that, but that's a story for another video, or maybe I will explain that a bit later. But this is how the entire system works. So the Federal Reserve can lower down interest rates to 1%, but it doesn't mean that your mortgage is going to be lowered down to 1%. If this is how the entire system works, then who exactly determines your mortgage rate? So you have on one side bank. The bank must make a profitable business. So it creates this product that is called a mortgage, and it will sell this mortgage to you. You're going to go to the bank, Bank of America or Chase or whatever, and you buy this mortgage. Now, for this mortgage to make economic sense, it must be profitable. If this mortgage that the bank is selling to you is not profitable, then why would the bank sell that mortgage to you? Remember, the bank is in the business of borrowing and lending money. So it's borrowing money from investors and lending that money to you in a form of a mortgage. So this transaction must be profitable for the bank to make economic sense. So the first thing you have to understand is that, does this mortgage makes profitable business or not? Now, how do we make it profitable? The first thing we have to consider is inflation. And if it's a 30-year mortgage, if inflation over the next 30 years is going to be 2%, then we can provide a mortgage at 3%, 3.5%, 4%. Now, over the next 30 years, a lot of things would happen. Sometimes inflation can rise to 4%, 5%, and sometimes it can go to as low as 0%. But if we assume, based on all the data that we have, that over the next 30 years, inflation is going to be on average 2%, then we can safely and calmly provide a 30-year mortgage at 3.5 to 4% interest rate, because we are making extra 2 percentage points on the top of it. But if we consider it that way, then 80% of Americans are not eligible for a mortgage, because 80% of Americans are very risky to give them a mortgage. Yes, the top 10% of Americans or the top 20% of Americans, with them, this business model is going to work because they have a stable job, maybe they have some assets, maybe they already have some kind of a house, maybe they're making a lot of money, maybe they work for the government and their $200,000 salary is guaranteed. There could be a lot of reasons that makes these people disciplined, they have money and safe investments. But 80% of Americans, especially those who are young, imagine somebody at 25 years old or 30 years old who just graduated from college. He has a lot of student debt, he has a lot of credit card debt, he plays video games, he's not disciplined. How are you supposed to provide a mortgage to this guy for the next 30 years at 4% interest rate? If he's going to default, then the bank will make a loss. And if the bank is going to make a loss, it still have to pay back the investors. And if cannot pay the investors, then the bank will go bankrupt. So it's not possible to provide these people with a loan. But the government is very smart. The government cares about the average American. Trust me, the government created a system to make sure that you as an average person can afford a mortgage. So here's what they said is that the government said to the banks that take all the mortgages, turn them into one giant security. We're going to call it a mortgage-backed security. So here's the bank. It provides a lot of mortgages, let's say 10,000 mortgages, and then it will take these 10,000 mortgages and turn them into one security, gonna call it mortgage-backed security, and then the government will say, we're gonna guarantee this mortgage. If this mortgage will be defaulted, the government will step in and will raise taxes on American people and will pay the investors. Now, this mortgage-backed security is suddenly a very great investment. It's backed by the government of the United States. Secondly, the job of the Federal Reserve is that we want to make sure that inflation stays at 2%, and if it ever goes higher than that, we will try our best to bring it down to 2%. So you have a bunch of investors with a lot of money, and they look at this deal, they're like, This looks like a really good deal. It's backed by the government, and the Fed says that we're going to control inflation. So if the mortgage-backed securities will provide us like with 4 to 5% interest rate, maybe we're going to buy them. But it only looks like a great investment by investors because of these two factors. And that's why mortgages are available to the vast majority of Americans. So when Bank of America is going to create this mortgage, it doesn't keep this mortgage at its disposal. It's instantly go and sells it to the investors in the form of mortgage-backed securities. So if you want lower mortgage rates, you want lower inflation. Just because the Federal Reserve is going to lower down interest rates to 0%, you're not going to have a lower mortgage rate because you cannot possibly fool these investors to buy these mortgage-backed securities when inflation is high and the Federal Reserve is lowering down interest rate. The job of the Fed over here is to lower down inflation so that this investor over here feels confident buying this mortgage-backed security. Well, if this is how the system works as you claim, then why on earth everybody believes that lowering down interest rates by the Fed is going to lower down mortgage rates? That's what the President of the United States seems to believe, at least according to him. That's what senators who run the US believe. That's what a lot of people believe. That's how the system works. So in 2020, we had some of the lowest mortgage rates. They were below 3%. So this was one of the best periods to buy a house. And it also coincides with the circumstances that the Federal Reserve lowered down interest rates to 0%. So by looking at these two factors, you can quickly see that lower interest rates, lower mortgage rates, lower interest rates, lower mortgage rates. So if we again lower down interest rates, we're going to have lower mortgage rates. That makes perfect sense. However, United States was not created in 2020. The US has been around for far longer than that. So let's take a look at other circumstances. If you just go back, for example, between 2009 and 2016, you will see that the US had pretty much almost 0% interest rate. They were between 0.5% to 0.8% and sometimes even 0.25%. Very, very close, if not the exact same thing as we had in 2020. But what about the mortgage rates? If you look at the mortgage rates, they were not as low as 2020. In fact, mortgage rates were about 4%, if not higher than that. Sometimes they went as high as 5% in some cases. So the question is that if lowering interest rates is going to bring down mortgage rates, why weren't mortgage rates brought down in this period? Let me give you another example. Let's go back to 2002 and 2005. Between this period, mortgage rates or the interest rates by the Federal Reserve were about 1.5%. But if you look at the mortgage rates, suddenly you see that they were around 6%. Even they rose up to 7%. So the Fed lowers down interest rates to 1%, but mortgage rates are 6%. The question is, why? The answer is very simple and straightforward. It's because the Fed lowering down interest rates does not equals to mortgage rates going down, because it doesn't work like that. What truly brings down 30-year mortgage rates is the rate of inflation. And as you can see that between this period in 1990s to early 2000s, mortgage rates were dramatically coming down. And that's because inflation was dramatically coming down, as I have explained to you. But if this is how the system works, then why in 2020 we had such a weird scenario when interest rates were lowered down and then mortgage rates also were lowered down to less than 3%? And that's because in 2020, something fundamentally different happened that a lot of people don't understand. Let me explain that in very simple terms. So you have the bank that provides you with a mortgage, and it creates the mortgage. Now, it must make sure that this mortgage is profitable for the bank. Now, the bank doesn't care whether that mortgage is profitable for you. This is the bank, it creates the mortgage, and it must be profitable for the bank so that the bank can pay back the investors, and also can the bank make a profit. Basic business model. But in 2020, the Federal Reserve suddenly says to the bank that, listen, Bank of America or Chase, whatever the bank is, you can create these mortgages and we are going to buy these mortgages from you. But the bank says investors do not want to buy them, but the Fed says we are going to buy them instead of the investors. So the Federal Reserve became the largest investor in the housing market. So the Bank of America creates the mortgage at 3% interest rates or 2.5% interest rate. Again, I'm oversimplifying things here so that you understand them. It's slightly more complicated than that, but if you get this point, you must be able to understand this. And then it will take this mortgage and then sell it to the Federal Reserve. And that's why if you look at the balance sheet of the Federal Reserve, this is the balance sheet of mortgage-backed securities specifically. You can read that. Assets, securities held outright. Mortgage-backed securities held by the Federal Reserve. In 2020, before the COVID happened, before the mortgage rates were lowered down, the Federal Reserve held around $1.3 trillion of mortgage-backed securities. By the mid or the end of 2020, it now holds almost $3 trillion or $2.8 trillion. So between 2020 and 2021, the Federal Reserve purchased $1.5 trillion of mortgage-backed securities. And that's why mortgage rates were low, and not because the interest rates were lowered down by the Federal Reserve. If the Federal Reserve did not buy all of these mortgages instead of the investors, then the mortgage rates would not have come down. So basically, you can say that the Federal Reserve financed the mortgages of the people who bought houses in 2020 and 2021. So the more mortgage-backed securities the Federal Reserve buys, the lower goes down the rates on the mortgages. It's as simple as that. Let me give you another example. If you go to prior 2008, you see that the Federal Reserve holds not a single mortgage-backed security at all. Because before the 2008 financial crisis, the Federal Reserve was not involved in the housing market at all. Now, 2008 financial crisis happens, the entire housing market collapses, and nobody wants to buy the mortgage-backed securities. There isn't a single investor in the world who is willing to risk his money and buy mortgage-backed securities because the housing market collapsed. So the Federal Reserve intervenes. It starts buying the mortgage-backed securities. And that's why you see that the balance sheet of the Fed, the mortgage-backed securities quickly rose from zero in 2009 to almost $1.7 trillion by 2014. And between this period, mortgage rates started going down dramatically. And this is what actually brings down mortgage rates. But what you have to understand here is that every time that the Federal Reserve buys mortgage-backed securities, you have to ask yourself the question, where does the Fed get the money from? The Fed is not a business. The Fed is the entity that is responsible for the dollar. So it creates the dollars. So when the Fed goes and it buys mortgage-backed securities, it says, please print $1 trillion, they take $1 trillion and buy mortgage-backed securities. And from whom they are going to buy it? They're going to buy it to bank, from investors. Now, these banks and investors have extra dollars that were just printed by the Federal Reserve. And now this money will be circulating in the economy, which means that we suddenly increased massively the supply of money by $1.7 trillion. And when you increase the supply of money in the economy dramatically by trillions of dollars, what does that mean? That means super high inflation. Now, inflation does not equally affect everything equally because asset prices rise dramatically fast, but prices in general might not rise that much because we track inflation based on different data, such as CPI. We take like a collection of items, and then based on them, we are going to say, oh, inflation is like 2% or 3%. And that's why when you print so much money into the economy, you cannot fool investors. Investors will know that you have printed so much money, and the new demand and supply of money in the market is going to raise asset prices. And that's why every time that you see that the Federal Reserve is increasing its balance sheet, you see house prices dramatically rising. So for example, in 2020, house prices have grown from about $330,000 to as much as $450,000 within a span of 2 years. So prices have risen by what? 30 to 40% in just 2 years? That is something unheard of. Why did that happen? Because the Federal Reserve printed so much money. Now, the same thing we can say back in 2008. You see that house prices collapsed in 2008. Nobody wants to buy houses during this period. And suddenly house prices tried to rise again. Why did house prices begin to rise? Because the Federal Reserve started buying mortgage-backed securities. And that's why if the Federal Reserve will be forced to lower down interest rates by the White House as they claim, it is not going to bring down mortgage rates. Which means that most likely the White House is going to pressure the Fed not just to lower down interest rates, but also start buying mortgage-backed securities in the open market in order to bring down mortgage rates for the average American. But when you do that, what will do that to the house prices? House prices are going to explode. They might rise by another 20%, 30%, 40%. I don't know. This is just speculation for now because we don't know how much money will be printed. There is literally no way to know that unless that is going to happen, which is why lowering down interest rates right now and forcing the Federal Reserve to further buy mortgage-backed securities to lower down interest rates for the average American is only going to cause house prices to skyrocket. If you can't afford a house now, I doubt you can afford a house when prices will rise by another 50%. Again, this is not financial advice. You should do your own research and know exactly what you're doing before you listen to me. But if you want to really know what I think and what I would do in this situation and how I would profit from this crisis, I have laid down my exact strategy. You can find it out using the link in the description of this video. Thanks for watching, and I will see you in the next one.